Coming up on Market to Market, containment progress in the fight against bird flu. Cold snaps and snowstorms blanket much of the country. Clothing manufacturers who survived when others unraveled. And commodity market analysis with Dan Hueber next.
What's next doesn't happen by chance. It happens when researchers and farmers work together to solve tomorrow's agronomic challenges. We're committed to creating what's next, because a pioneer, our name is our mission.
For over 45 years, Steiner Tractor Parts has shared your love of antique tractors, new parts for old tractors. Learn more at steinertractor.com or at 877-559-7887.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today.
This is the Friday, February 21 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Paul Yeager. The large sector of the existing home sale market retreated in January. Stubborn mortgage rates pressured buyers as the number of units sold fell 4.9% and added a third consecutive month of declines. The U.S. Senate worked into the early hours of Friday to approve a $340 billion budget framework. Now, if the measure passes both bodies, the series of votes will provide the Trump administration money for mass deportations and border security. Other Trump administration needs have been addressed through staff and program reductions. New USDA Secretary Brooke Rollins held a farmer roundtable this week, hearing concerns on many issues. One of the first items on the docket is addressing the viral disease H5N1, or highly pathogenic avian influenza. The practice in the first few years of the fight against HPAI included culling the flocks, often millions of birds, where positive cases were identified. A new strategy could focus on medications in the perimeter of infection. Peter Tubbs reports on the latest impacts.
H5N1 continues to spread through the nation's poultry flock, but the pace of spread may be slowing. 2 commercial flocks of poultry were diagnosed with H5N1 avian flu this week. Both infected flocks were in Ohio and involved 175,000 birds. The 2 confirmed infected sites are a drop from last week's 16 commercial cases, which forced the destruction of 4.5 million birds. The Trump administration announced this week it is planning a new strategy for combating the disease, including enhanced biosecurity measures and limiting the number of birds destroyed on a farm that has a confirmed case of the virus. Almost 3/4 of the birds culled due to H5N1 since 2022 have been layer hens. Consumer prices for eggs approached an average of $5 this week, and the USDA estimates that prices will rise another 20% this year. The Trump administration is also scrambling to rehire USDA employees who had been working on the front lines of the avian flu outbreak, who were fired as part of a mass layoff at USDA. From Market to Market, I'm Peter Tubbs.
The U.S. Climate Prediction Center said Thursday the conditions for La Niña remain present, and there is a 60% chance this lasts through April. However, it is a weaker pattern and will stay through the end of May, holding some influence over the remainder of the South American production season. The North American weather pattern was pretty simple: cold. David Miller reports.
Cold weather blasted across the entire country, plunging much of the grain belt into record territory, with many readings well below zero. Frigid temps broke low records from North Dakota to Louisiana, with meteorologists calling these the last truly cold days across the country this winter. The harsh conditions descended on the nation's midsection at the beginning of the week. Schools in 7 Midwestern states were closed, and at least 17 people lost their lives across the eastern part of the country. temperatures in Bismarck, North Dakota plunged to a record-setting minus 39 degrees. Parts of Oklahoma dealt with freezing rain and snow. Farmers and ranchers were keeping a close eye on their herds to avoid losses from the weather. Wheat rallied on the fears over winter kill. More than 10 inches of snow fell on parts of Virginia, knocking out power for several thousand customers. The state police dealt with nearly 500 car accidents. Up to 8 inches of rain hit Kentucky and Tennessee, causing heavy flooding. Next week, there is the potential for highs in the 50s, which, for some regions, will be a 60-degree temperature shift in just hours. The snow and rain have reduced the amount of drought across the nation by 4 points as the winter weather recharges soil moisture. 2 years ago, drought levels were also this high. For Market to Market, I'm David Miller.
The Industrial Revolution took hold in the U.S. in the early 1800s. A century later, offshoring took hold as American manufacturers moved to find lower labor costs and tax breaks at its peak in the 1980s. This may have improved some bottom lines, but it created a vulnerability exposed in the early months of the COVID outbreak. It became clear there were a large number of items no longer carrying the Made in the USA label. For those that never left and others who've returned to the U.S., there is some reason for optimism. Colleen Bradford-Krantz has more in our cover story.
In the early days of the nation's history, most clothing worn by Americans was made at home. Mass manufacturing of clothes didn't take off until the late 1880s, rapidly growing into a booming industry centered in New York City. Apparel companies soon began to crop up elsewhere, including in distant rural communities with a nearby supply of cotton or with other industries whose workers needed certain types of clothing.
We started in 1903. Shawnee, Oklahoma was a big railroad town at the time. It had two different railroads, the Rock Island and the Santa Fe railroads both met here. And the railroad workers needed something to wear, and so we got started by producing jeans for the railroad workers to wear.
In recent decades, however, the once thriving U.S. clothing industry has undergone a disheartening historic shift. 30 years ago, there were more than 741,000 production employees below the level of supervisor. That number has since slid over 92%. The job count hit a low point during the COVID pandemic, with just 49,100 apparel workers in April of 2020.
Apparel manufacturing in the United States has always been important for rural America, and it's something that probably reached its high point in the 1960s and 1970s. And since then, we've really been losing a lot of apparel factories, the majority of them.
However, there is reason for cautious optimism. Other than that dip during COVID, the industry's apparel manufacturing employment levels may have begun to level off in recent years, hovering around 65,000. What has been left behind is a kind of camaraderie among those who survived a period when most clothing manufacturing moved overseas.
The industry for American-made products probably is growing more and more amicable. More and more people see it as something that we want everyone to thrive in. And so probably in the 60s and 70s, you had a lot more competition where people were fighting and actually trying to steal sales from other people. But we think it's great when anybody that makes something in the United States has sales, and we want to encourage other people to start a company.
Today, over 98% of the clothing sold in the U.S. retail market is imported, the majority from Asia. Roundhouse, which has about 30 employees, survived by keeping expenses carefully under control. The company, which David Antosh owns with his father and brother, made it a priority to keep their American-made jeans and overalls affordable. They sell over 100,000 pairs of jeans annually, using 100% American-grown cotton. They don't advertise, and the owners can often be found working on the factory floor.
We have employees here who have spent their lives working here and know how to make jeans as quickly and as efficiently as possible, because our whole goal is to make affordable American-made jeans. We try to keep everything here at $59.
Roundhouse has found that consumers are seeking out American-made clothing as it becomes harder to find. Over 90% of the company's international sales are done in Japan, where customers are willing to pay for the heavier denim and the attention to detail. 700 miles to the north, Fox River Mills in northern Iowa continues to manufacture its socks and other apparel in the community of Osage, which has a population of about 3,500.
Fox River Mills is the oldest operating sock mill in the United States. So it was founded 120 years ago along the Fox River in Appleton, Wisconsin, and ended up here in Osage, Iowa. Continually operating, never stopped, didn't stop for any of the major events that we've seen throughout our history, continued to knit products. So I'm very proud of that heritage, for sure.
Warren says their niche market of specialty and high-quality socks, ranging from military to high-tech to casual, as well as knitting products for other companies, has helped them survive.
With the globalization of trade and trade agreements and the impacts of those through the 80s and 90s, we saw a lot of filter offshore, and you fast forward to today, I think maybe only 3% or somewhere in that range is apparel is manufactured in the United States. So dramatic change, certainly a global economy, certainly a competitive open market for the most part.
Fox River relies on the town and surrounding area to keep their 170-person workforce strong as they turn out 5 million pairs of socks annually. In turn, the town counts on those Fox River jobs to help keep the area economically viable.
A lot of apparel manufacturing started in small town America, and you see a lot of that in the Southeast. Through Alabama, the Carolinas, you see small town America with manufacturing plants that sustain those communities and sustain those families for many, many years. Some towns that still have manufacturing, but it's just a fraction of what it used to be.
Both Roundhouse and Fox River struggle to find experienced workers in rural areas with smaller populations. However, smaller communities do provide some marketing benefits.
One example would be our Knit in Iowa is really the moniker that we claim. We're made in the USA and we're knit in Iowa, and we're very proud of that heritage. And you can create, an identity, which we have over the course of many decades, that connects and resonates with many consumers.
Both companies are hopeful due to the hint of a small resurgence in U.S. apparel manufacturing.
It's not huge, but you're seeing a lot of smaller entrepreneurial operations that are coming into, in some cases, abandoned locations that still have old equipment, and renovating that equipment and establishing brands and establishing a brand proposition around specialty.
And should the U.S. apparel industry continue to grow stronger, Fox River and Roundhouse expect to be right there pushing the needle for another 100 years. For Market to Market, I'm Colleen Bradford Krantz.
Next, the Market to Market report.
Corn and wheat kept big sell-offs at bay with some technical and export support. For the week, the nearby wheat contract lost a dime and the March corn contract fell a nickel. Trade talk and a change in palm oil purchases helped the soy complex, while rain returned to the forecast in Argentina. The March soybean contract gained 4 cents, while March meal fell $1.10 per ton. March cotton contracted $1.25 per hundredweight. Over in the dairy parlor, March Class 3 milk futures cut 65 cents. The livestock market was mixed. April cattle declined 30 cents. March feeders added $1.20. And the April lean hog contract shed $4.92. In the currency markets, U.S. dollar index lost 6 ticks. April crude oil fell 24 cents per barrel. COMEX gold expanded $59 per ounce. And the Goldman Sachs commodity index added more than 8 points to settle at 571.20. Joining us now, regular market analyst Dan Hueber. Hi, Dan.
Hi there. How are you?
I'm well. I'm
Very
well.
good.
I'm well.
Very good.
And I was reading some of your commentary this week, and you said if we would have the weekly lower close on the big three, that would open up some things. 2 of the 3 happened. What's that tell you?
The stagnation, I think we've enjoyed really a very nice rally in these markets for the last 7-8 weeks, really since the middle of December. And as all things, we've adjusted for some adjustments in lower production numbers of the corn, most specifically, a little bit of kickback in demand. But here again, that's what the function of the market. We should adjust for those changes within the supply-demand picture, and then you need something new to make it go any further. And I think we've probably kind of exhausted that story at this point.
Wheat had its own movement, then corn kind of gave it a boost.
Right.
But wheat kind of ran out of, even with the cold snap.
Right.
Again, we don't know the damage of the U.S. story. Sure. What is the story then in wheat?
Well, of course, in wheat, when it comes to winter kill, nobody really knows until we, of course, get into the spring and summer months. Where you've got a kind of a dichotomy going in the wheat right now is when you look domestically, there's certainly nothing bullish. When ending stocks continue to grow, I think we're going to be the highest we've been in probably the last 5 years, somewhere in that neck of the woods. But then if you look over at the global stocks continue to contract. So you've got kind of a push and pull situation there. So if other problems do develop with some, let's say, winter kill in Russia, Ukraine, maybe even in some of the European nations, then you might be able to build on that story a little bit. But I think at this point in time, until we see something more concrete, it's going to be difficult to extend prices above and beyond where they've been already.
If you haven't sold, did you miss your window in this cycle?
Well, I think we're still there. We really have not lost much ground on wheat or corn, either one, particularly if you look at new crop corn. It's really at the highest level. It's even with a little bit of loss today, it's at the highest level we've been here in months. So no, I think right now is an opportune time to take advantage of this rally. So,
in the old crop corn story, then, for what that is left,
sure.
We had a March rally that was interesting, but has since gone away. Do you think the bulls have left the building?
Oh, they haven't left yet. In fact, even on the Commitment of Traders reports, the managed money is still very heavily long in the corn market. Of course, that isn't necessarily just in the front months. But I think they're starting to make their way towards the exits. Even the spread activity this week was not particularly encouraging when you have the new crop gaining over the old crop. That is not necessarily a good sign for continued rally. So yeah, they haven't started running in mass for the door yet, but unless they get something fed pretty rapidly, there's not much reason for them to stick around at this point either.
You kind of talked about the new crop there just a minute ago, but yes. I want to go back to new crop corn here.
Sure.
We kind of hit a technical target, kind of like an 8th month, if you draw the line on the chart. What does that mean?
Well, there's actually a number of targets that were hit this week. When you look at some of the longer-term charts in December corn, on just the December weekly, we made some good retracements, tested some highs of a year ago. So as much as anything, there are areas to watch. There's nothing magic that says we have to stop at those zones. But that said, next week we're going to hear some acreage estimates. Granted, they're going to be statistical estimates that are going to be generated by a computer, but I think for all intents and purposes, most people feel we're going to see extra corn acreage out there next year. So unless you can back that up with a weather issue, higher acreage, ample supply, not a burdensome supply, but an ample supply of corn, then how do you really justify taking prices higher?
Well, the CoBank said this week that, we're going to have more acres, we're going to have resilient prices. You've got USDA for them, not an official report. It's more of a discussion of things.
Correct.
However, it's kind of a wink and a nod, right, of some things to come?
To a large extent. And if you look over the last several years, it's really been pretty accurate. So, there is a lot of good things computers can do statistically, and this seems to be one of them. So I think the numbers that come out next week probably not they're going to be set in stone by any stretch of the imagination. We've got a lot of weather in front of us, but they're you can almost take them to the bank as well.
In the soybean pits, it has been a lot of technical signs because the fundamental news has been hard to come by.
Well, positive fundamental news is hard to come by. There's fundamental news out there. Export sales, we did bounce back a little bit here this last week, but sales have really drifted off. We know the South American harvest is going to just continue to pick up pace. They're going to take a larger and larger share of the current business that's happening. Yes, the report that came out last week, was that last week? Or, as far as the supply demand, it really... you could say it was a little bit positive to the beans, that the carryout was not as high as expected, but it's still growing each year. So it's just not as overwhelming as we once thought it was. So.
Walk me through the palm oil, soy meal issues and how that's influencing this complex right now.
Well, and of course, palm oil did have the bright spot this week. It did give our bean oil just a little bit of a bounce. Really did not do a great job of sustaining it. So, it's probably more just, something new, a little bit of a flash in the pan. But of course, when it comes to the spreads, I mean, if we have a strong bean oil market, chances are you're going to offset that with some sales in meal. So you've got meal really just kind of floating around year contract lows. So, and I think even in the bean oil market, I mean, like I say, 2-3 days ago, it really looked like we could have taken off, and it just kind of fell back into the same zone. So I think it's more of a stagnant market than anything that's really developing for a big push to the upside at this point.
Well, what you just said, stagnant, which means you're raining on my question before we get to it here. Dan in Nebraska wants to know, Dan, what is the outlook for the commodity super cycle for grains?
What a great name. What a great name. Well, I don't think when it comes to the major up super cycle, and I'm assuming that's kind of what he's referring to, I think we're several years away from that yet.
Years?
Years, yes.
What has to change?
We're going to have to develop a major change in the entire fundamental picture. Right now, everything we have there, we've known for years. We know what the ethanol picture was, and the ethanol truly was the stimulus for the last major super cycle when it came to corn. Where's the next one coming from? We know that's a constant in the market here at this point in time. We may have a little shift year in, year out as far as how much corn is actually used for ethanol, but as a whole, that's factored in there. We're not seeing any major changes in the livestock industry, so it's going to have to be something new, or somehow or another we're going to eliminate a major growing portion around the world, and right now I'm not sure where that would be either. Argentina has their problems, but they aren't going away by any stretch of the imagination. So
I think the corporate term is we're going to put a pin in that, because I have some more follow-ups to that. We'll get into Market Plus. I need to move to livestock here as we wind down. Cattle on feed report came out today, 102, 101, 98. What do those numbers mean?
Numbers really exactly what the trade was expecting, and every single category. And plus, you're looking at placements a little bit higher. I didn't really have a good look at the weight breakdown there, but I mean, that would tend to say we're going to have some more beef available for market down the road here. So it's, I think the big question in the livestock market, both cattle and hogs at this point, is can we sustain the demand? And each have enjoyed some very substantial, nice rallies, and are showing signs that we're backing away from wanting to eat quite as much of this product.
The cattle chart that's on now, that is a trend below that 193 off the 208. That was numbers we just haven't seen.
Right.
Are we going to get close to that number again, above 200?
Well, not that I think we'll see a rebound back towards that area, but to go back to the 200 level again, I think that might have been, we set the precedent, we set the new record, and we might not see that for some time in the years ahead.
And would that be one of those major fundamental changes would have to happen to change that market?
Well, and of course when it comes, not that we don't use a fair amount of corn when it comes to feedlots and cattle, but I mean, that's, taking the numbers back, it's first going to impact primarily what's on grass, and of course you'd have to see a lot of cattle come back but boy, you're talking about years in development to make that happen. So it's
well, that market's been a years-long story.
Oh, certainly.
And the hog market has had its own story where it had enjoyed a run-up, and then is this reality, or is this a pullback before we snap higher?
I think you've got some concern. Not that we're really seeing a breakdown yet necessarily in the exports, although they've been a little bit flaky since the beginning of the year, a little bit soft. But I think, there's concerns about what the economy is going to do. We're concerns about a number of layoffs that we've, of course, been hearing about here in the last week. And that continues to grow. And I think the concern in both of these markets is, can we continue to sustain the retail side of this at this point in time?
Yeah, the hogs have been dealing with weaker domestic demand. There's been, I think, some longs have liquidated their positions too.
Certainly. Yeah, starting to back away from those markets. So it and all markets. Particularly, we had a 4 or 5 month run here at this point in time. So yes, we're going to stretch it out. We get a little bit too top heavy. We have to come back and kind of wash those markets out and see where we stand. But to come back to the same levels that we just did we better find some really solid demand to make that happen. And I don't know where that's really going to come from at this time.
All right. Dan, good to see you.
Likewise, thank you.
Thank you for the time and the insight.
My pleasure, thank you.
Dan Hueber, everyone. And we're going to pause the analysis, continue our discussion about these markets in our Market Plus segment. You can find both analysis and plus on our website of markettomarket.org. We were producing podcasts before it was cool. The Market Analysis and Market Plus come your way each Friday. Then on Tuesday, you get our third offering, the MTOM. Subscribe wherever you get your podcasts. Next week, a look back at the 90s and early aughts for this program. Thank you so much for watching. Have a
What's next doesn't happen by chance. It happens when researchers and farmers work together to solve tomorrow's agronomic challenges. We're committed to creating what's next, because at Pioneer, our name is our mission.
For over 45 years, Steiner Tractor Parts has shared your love of antique tractors, new parts for old tractors. Learn more at steinertractor.com or at 877-559-7887.
Tomorrow. For over 100 years, we've worked to help our customers be ready for tomorrow. Trust in tomorrow. Information is available from a Grinnell Mutual agent today.